Everyone says long-term investing is easy. Just buy, hold. Wait, that's the story. Clean, comfortable, reassuring. And it's wrong. Not technically wrong, but dangerously incomplete. Because the biggest lie beginners believe about long-term investing isn't about stocks, or returns, or even risk. It's about time. And by the end of this video, you'll understand why two people can follow the exact same long-term strategy. Buy the same assets, live through the same markets, and end up in completely different financial realities. Not because one was smarter, but because one understood the part nobody talks about. Let's start with why this idea exists in the first place. Long-term investing became popular because, historically, it worked. Zoom out far enough and markets go up. That chart everyone shows you, the one that slopes upward over decades, that part is real. Over the last century, broad U.S. stocks returned roughly 9 to 10% per year on average. That number is burned into every book, podcast, and retirement calculator. And it sounds comforting. Put money in, do nothing. Let time do the work. The problem is, time doesn't work the way beginners think it does. Because long-term is not a smooth line. It's not a calm journey. It's a psychological endurance test with terrible pacing. Let's walk through how the system actually works. When you invest long-term, you're not buying returns. You're buying exposure to uncertainty. Every single day your money is in the market, it's exposed to randomness you don't control. Economic cycles, policy mistakes, wars, bubbles, narratives that flip overnight. The long-term return only exists because investors endure long stretches where it feels broken. This is the part beginners don't internalize. They hear 10% per year and subconsciously imagine something like this. Some years up a little, some years flat. Occasionally down, but not for long. That's the lie. The real experience looks more like this. Years of nothing. Then sudden drops that erase half a decade of gains. Then slow recoveries that feel fake. Then a surge that comes when most people have emotionally checked out. Markets don't reward patience evenly. They punish it randomly and reward it violently. Here's the uncomfortable math. If the market averages 10% per year over 30 years, that does not mean it returns 10% every year. In reality, most of those gains come from a small number of explosive periods. Miss a few of them, and the average collapses. Historically, a large portion of total stock market returns comes from just a handful of days each decade. And those days often happen right after crashes. When fear is highest, when headlines say the system is broken. So when beginners say, I'm investing long-term, what they often mean is, I believe markets go up eventually. What they don't realize is what they're agreeing to emotionally. They're agreeing to sit through stretches where their strategy looks stupid. For years. Let's talk about time, not in years, but in sequences, because long-term investing doesn't fail people evenly. It fails them based on when life interrupts. Imagine two investors. Same strategy, same index fund, same contribution rate. One starts investing during a long bull market. The other starts right before a major crash. Mathematically, both are long-term investors. Psychologically, they are living in different universes. The first investor sees early wins. Their account grows. Confidence builds. They trust the system. The second investor sees losses immediately. Every contribution goes into a falling market. Every statement feels like confirmation that something is wrong. Same strategy, different emotional cost. Now add real life, job loss, medical bills, a housing decision, a child, a divorce. Long-term investing assumes you never need the money at the wrong time. That's the quiet assumption buried under every chart. But life doesn't ask for permission. And when people are forced to sell during downturns, the math breaks. Not because markets failed, but because time ran out. This is where the biggest lie shows itself. The lie is not markets go up. The lie is time is always on your side. Time only helps if you can survive the path. Let's talk about drawdowns. A 50% loss requires a 100% gain to recover. That's not opinion. That's arithmetic. So when the market drops 40%, which it has done multiple times, you're not just down. You're delayed years. And those years matter if your contributions slow, stop, or reverse. Now here's the irony. The most dangerous period for long-term investors isn't the crash. It's the years after, because that's when impatience sets in. The headlines calm down. The panic fades, but the recovery is slow and boring. This is where people quit. They don't quit at the bottom. They quit after 5 years of nothing. That's when the narrative changes from stay the course to maybe this doesn't work anymore. And this is exactly when future returns are quietly being built. The market doesn't announce when patience will pay. It only reveals it in hindsight. Now let's contrast hype versus reality. Hype says, just invest consistently and you'll be wealthy. Reality says, you'll probably underperform your own expectations. Because most people measure success against imaginary timelines. They expect progress every year. They expect effort to feel rewarded. Markets don't work that way. They compress rewards and spread pain. Another uncomfortable truth. Long-term investing doesn't protect you from bad timing. It just averages it. If you invest heavily near market peaks, your long-term returns can look mediocre for decades. Japan is the classic example. The stock market peaked in the late 1980s and didn't meaningfully recover for over 30 years. That's not a theory. That's an entire generation. Long-term didn't fail them. Time did. Now zoom out. This matters more today than it did before. Because beginners are entering markets with higher valuations, more leverage in the system, and narratives that promise certainty. Index funds, passive investing. Stocks always go up. These ideas are directionally true, but emotionally misleading. They remove responsibility from the investor. They imply that patience alone is enough. It's not. What actually determines long-term success isn't intelligence. It's survivability. Can you keep investing when it feels pointless? Can you avoid selling when it feels rational? Can you structure your life so markets don't force decisions? That's the real skill. And it's rarely taught. Because it's uncomfortable. It doesn't fit on a chart, and it doesn't sound good on social media. Here's a quiet truth most people don't like hearing. Long-term investing is less about returns, and more about behavior under boredom and stress. The math is easy. The waiting is not. So when beginners say, I'm in it for the long term, the real question isn't how long. It's how fragile their plan is, because time doesn't just reward patience. It exposes assumptions. And the market has a way of testing them when you least expect it. So here's the unresolved question to sit with. If the next 10 years look nothing like the last 10, if returns come later than you expect, if progress feels invisible longer than you're comfortable with, will you still call yourself a long-term investor? Or will time quietly prove that the lie wasn't about markets at all? It was about how long you thought you could wait.